Hi everybody, this is Jason Wilson with Wilson Realty Group. Today we're going to talk a little bit about loan product. Loan product has to do with what type of loan are you going to get to purchase a home. Different loan products have different benefits, and we're going to cover a few of those like FHA, VA, USDA, and a little bit about conventional today. Stay tuned. Welcome back. So when it comes to loan product, a couple of things that go into that depends on your particular situation. So let's go with a side-by-side comparison of a conventional 3% down and an FHA 3.5% down loan. Well, there's some limitations, right? Of course, the conventional loan has a slightly lower down payment. However, somebody on the loan, one of the parties, has to be a first-time home buyer to qualify. Otherwise, they'll have to go conventional 5% down. Where FHA, it doesn't really matter. It just needs to be an owner-occupied home, meaning not an investment property. The person buying it is going to live there. Well, what's the differences? Why would I choose, if we're a first-time home buyer and I can go FHA or I can go conventional 3%, why would I ever choose to go one way or the other? Well, there's some limiting factors in there that you have to consider. For example, if your income, let's just say you're self-employed or you're employed by a regular job that gives you a W-2 income, and you also do some work on the side which increases your income. That side work income might not be usable in doing what they call the debt-to-income ratio to qualify you. So even though you can afford a house, the conventional loan's debt-to-income ratio really wants to keep you in the low 40s, between 43 and 45% debt-to-income ratio in order to qualify you for a house. Where FHA, we can push to somewhere between 50 and 55% debt-to-income ratio, which means if you wanted to go buy a particular home and you're a first-time home buyer, you might be able to, on that 3%, afford a $200,000 house. But the house you're looking at is really $225,000. Well, you might decide to go FHA for that $225,000 simply because you can go with a higher debt-to-income ratio to qualify for it. So what are some of the pluses and minuses? FHA, even though it's 3.5% down, has a mortgage insurance premium that never goes away on the loan. Conventional has a private mortgage insurance premium that remains until you pay the house down to approximately 79% of loan to value. Then that'll drop that off, alleviating the payment. Well, I would go conventional if the debt to income ratio was low enough to afford it. However, if it's not, FHA might be the way you want to go. And briefly, we'll cover a couple other products like VA. If you're a veteran and you're eligible and you have an eligibility certificate from the VA, you can purchase a home with no money down. So that is a great option for those that have served our country. USDA is also a no money down loan, but that has more to do with where the house is located. You cannot get a USDA loan in certain areas. So if you qualified for a USDA loan, you would want to look at the house specifically that you're interested in to see if it's within the USDA footprint. This will be in more rural areas. USDA also operates with a lower debt-to-income ratio like conventional loans do, meaning you cannot be 55% of your debt-to-income with your house payment, car payments, all your revolving credit debt, and still get the house USDA. You'd have to go FHA. Again, there are so many factors that go into this conversation, but if you're thinking, do I qualify for a loan, give us a call. We'll connect you up with a lender, and we can run through the options and find the best fit for you for the least amount of money. Thanks so much.